Good morning and welcome to our webinar on Eastern Europe. Today we speak about markets like Turkey, Poland, and smaller ones like Romania. My name is Jacob Grapengiser. I'm the CIO of East Capital, and today I have my colleagues Egle Fredriksson, PM for Eastern Europe, and Dilara, an analyst covering the Balkan markets and Turkey. I wanted to start by highlighting our summit in Tallinn this fall. So early November we'll actually celebrate the jubileum. It's 20 years since we had our first summit, and that one was in Tallinn. So we come back to Tallinn. We think it's very interesting. We will of course see how the city and the country has enormously developed since then. But we have the business and thought leaders with us to tell you more about what's going on in Central Eastern Europe. So please reach out for us if you want to join this fantastic trip. But now let's get back to the markets. So it's been a remarkable past 12 months. I think a lot of investors have noticed that Eastern European markets are doing well. Actually, some of our funds are the best performing in Sweden over the past 12 months. But Egle, perhaps you can tell us exactly how well they have done.
Yeah, so if we look at the market performance, you see that Turkey was one of the best performers in the world, up 48%, and that is twice as fast as the developed markets. And it's not only Turkey. Poland was not that far behind. And then if we look at our funds, which is especially pleasing for us and our clients, they were performing even better, delivering 13% alpha. And if we look to the next slide, of course, all these countries were having quite specific drivers, but in general, one major driver for entire region was a very strong economic growth. Since 2019, we've seen our countries in Eastern Europe outperforming the regions, even like United States, not even talking about the old EU countries like Germany, which was declining during that time.
Yeah, thank you, Egle. These numbers are really strong, but I still think that investors fail to realize how strong they are, and especially, how well some of the companies in the consumer sectors are doing. We'll get back to that a bit later. But while everyone is fresh, we start off with Turkey. Turkey is a country we discuss almost on a daily basis for the past 3-4 years. And the reason is because it is very complicated. So Dilara, please tell us more about it.
Sure. Yes, Turkey is very complicated, but it's also very interesting and filled with opportunities. The stock market has hundreds of stocks, great corporates, and an active local investor base. But unfortunately, the cycle of currency devaluations and high inflation has made it a quite challenging place to invest. So in the slide you see, we tried to put everything into context, with the root of the issue being the highly unorthodox monetary policy that has scared off foreign investors. If we rewind to 2018, interest rates were kept too low and there was significant inflation-inducing currency devaluation. They eventually reversed course, but in 2021, Turkey entered another premature rate-cutting cycle despite rising inflation. On the graph, you can see the scale of the challenge. In 2022, despite inflation surpassing 80%, the policy rate was continually cut all the way down to 8.5%. However, now we're in a very different period. We're in a period of policy reversal, and this one looks like it will actually last. So after the presidential elections in 2023, we saw a 180-degree turn in terms of economic policy, and this was put into place by a highly competent new economic management team. And what's different now than in the past is that the Turkish Constitutional Court has actually deemed it unconstitutional for the president to fire the head of the central bank. making it more difficult to implement those low interest rate policies. Now, Turkey has gone from a policy of low interest rates and high loan growth to a place where the policy rate is now 50% and there's controlled loan growth. So Turkey is now entering a normalization period, and the end goal is ending the cycle of currency devaluations leading to inflation. The fact that the lira has already been predictable this year has already removed one of the main challenges in investing in Turkey, which is currency volatility. And we think that starting from the July print, this lira stability should lead to dramatic drops in inflation back to back, and we'll likely see inflation end in the 40s by the end of the year, which you see on the graph. It should continue downwards to 25% in 2025. I think foreign bond investors who have done their macroeconomics homework have bought into this turnaround in the billions this year, but on the other hand, foreign participation in the equity market, so equity investors have stayed away. Foreign participation remains low at 32%, while in 2018, so prior to the start of the inflationary cycle, it had been 65%. This means that foreigners have largely missed this rally in the stock market. In contrast, East Capital, by keeping an eye on the market, has made 24% in dollars in 2023 and 52% in 2024. And I think that foreign buying will likely be key to the next leg up in the stock market, but foreigners will likely remain cautious until improvements are realized. So we've seen currency stability, which is one requirement, but I think it needs to be backed up by a fall in inflation to show that the policies are really working. I think recent performance is not a bubble, and has been driven by the expansion in the size of the economy, as Egle was discussing. On price to earnings, the market remains cheaper than Eastern European peers at 5.2x. It's nearly repriced to its 5-year average. We think that stocks still look appealing, especially given the EPS growth outlook of 44% this year, 36% next year. So a fall in inflation should lead to stock market performance also through multiple expansion. If we see a true normalization and inflation in the 10s, like we did prior to 2018, we can expect PEs to go even higher, perhaps towards 8x, twice as high as the 2025 PE.
Yeah, thanks, Dilara. I think from my point of view, it's been a kind of remarkable change in stance from the central bank, right? Effectively hiking the interest rates to these very high levels. Now we are waiting for inflation to come down, but of course, if we see that, that would be very clearly triggering the next leg up in the Turkish market. Having said that, though, Turkey's been a very tricky market for the past couple of years, so the jury is probably still a bit out on that one, but fingers crossed. All right, so let's move over to slightly more predictable markets where I think stars have been pretty much aligned. So we move to Poland, Egle.
Yeah, so Polish market, if we look at the past year, it has seen a very important victory of the market-friendly democratic opposition, which after 8 years of not so market-friendly ruling of PIS was very remarkable for Poland. And investors were really welcoming this historic change of political direction that returned Poland to European values, rule of law, free media, and also improving corporate governance in state-owned enterprises. So this victory was also very important for Polish access to EU funds. Majority of EU countries has been seeing like a steady inflow and strong inflow of EU funds, which for Poland has been delayed due to some issues with the rule of law and conflicts with PIS government, which now are resolved, and we are expecting those inflows that already started from last December to continue throughout the upcoming 3 years. And as you see in the slide, they are adding a big portion of to GDP growth when they are accumulated only in 3 years. That's up to 30% of GDP in the coming 3 years. So another strong driver for the market has been a very significantly improving profitability of the banks. So higher for longer rates in Poland means improved and recovered profitability of the banks that previously seen some quite market unfriendly regulation and different pressures. So currently Polish banks offer dividend yields of up to 13% and ROEs between 15 to 20% for quite a long time, as we see higher for longer rates as mentioned. But these are drivers of the past. What do we see when we look forward? And I think very important new driver, or the driver that is emerging now, is the actual boost in consumption. If we look at the sort of structure of the consumption, of course, first of all, it's driven by real wages. And real wages were under pressure in the last couple of years due to high inflation. And as inflation recedes, wages in real terms are going up to 8% this year. And on top of that, we see very strong social transfers, or so-called social benefits that government is paying to low-income takers. These are things like support to the family in cash payouts, lower taxes or higher wages to the public sector. So these social transfers can add up to 5% on the top of that expected consumption. So that's why we think that this period will be seeing quite a bit of rebound in Polish consumption and GDP.
All right. So how do we play this? How do we play the consumption theme in Poland?
Yeah, so we've been looking really hard and deep, I would say, in the Polish market. Currently, our portfolio is quite strongly biased towards consumption. We have 6 strong companies, but I wanted to shed a light on the latest acquisition that we did a couple of months ago. It's a retailer or online and brick and mortar retailer, CCC, that is one of the biggest shoe retailer in Central Europe, but they also are involved in other fashion products. And we met the company a couple of months ago, and we heard that a strong and very entrepreneurial founder has returned to the company, and he did a very significant overhaul of the supply chain and the cost structure, which already in the first quarter resulted in 800 basis points improvement in the gross margin. So you can imagine this was a big surprise to the market. The stock rallied, but it's still quite cheap in our view, because when we model it, we expect EBITDA this year to grow 120%. And at this high growth, the company trades just 6 times EV/EBITDA, which is about 30% discount to comparable companies in the region.
All right, thank you very much, Egle. So in Eastern Europe, there are many countries. One of them we like is Greece. Greece just announced that they're moving from a 5 to a 6-day working week to increase productivity. I think that's slightly controversial in the European context. We'll see how successful that will be. But we wanted to share an example from a smaller market. So, Dilara, you have an interesting Romanian company for us.
Yes, Jacob, I do. So I want to introduce this small cap company from Romania. Many people don't actually realize that the wine region around Romania and Moldova ranks 4th in Europe, so right after Italy in terms of quantity of wine produced. And the company I want to tell you about, Purcari Wineries, produces around 10% of the wines in that region. So while they're a micro cap, Purcari is not just a small vineyard, they're a large-scale wine producer with big ambitions to become a market leader in Romania and expand around the world. They currently have 12% market share in Romania, and want to expand this to 20%. So in the past 3 years, they've been able to grow their top line 22% per year, and they want to continue to grow in the double digits while also expanding margins in the coming years. Furthermore, given that the wine market is very fragmented, there's many producers, a lot of which actually struggle to turn a profit, consolidating this market is also another way Purcari can grow. And they've really shown they have the business acumen and know how to make wine profitable. Purcari is really a gem of a stock. The company is fast growing. It has a low valuation, just 8 PE for the next 4 quarters, high free cash flow yield of 9% this year, 16% next year, and it's also high quality with a return on equities in the 20s. So these are the kind of metrics that a stock picker would look for a good stock.
Yeah. So just to keep it very simple, the stock is trading at 6 times earnings for next year with I think it's at 50% earnings growth. So this is doing really well. I think from a more practical point of view, it's summer now, and if you want to buy good quality wine at a decent price, you can buy, for example, a 20 euro wine with 94-point score from decanter. So anyone who likes wines above 90 points are generally considered very good, but I think it's very rare to buy them at 20 euro. And you can buy that at Swedish Systembolaget if you're in Sweden, or in most countries in Europe. So please try it out during the summer. But I wanted to come back a bit to the markets, right? So we've seen this spectacular performance. It's really been spectacular over the past 12 months. Typically, that means for markets that, valuations are a little bit stretched. So we just wanted to take you back and look at the concrete numbers here, right? So the gray area is the average valuations for each and every market, and the red dot is the current valuation. So if we look on the whole range from Kazakhstan, Turkey, Romania, Slovenia, we can see that all markets except one are trading below their historical average. In Kazakhstan, the market is at 4.5 times earnings, in Turkey 5.6, Hungary 5.8. I don't want to go through all the numbers, but I think the point is that on average they are very cheap, and they are trading, give or take, 30% below historical average numbers. If we turn to our fund, I think it looks even better actually. The fund is trading at an PE of 8 for this year, or 6.7 for next year, but that's with an earnings growth of 17% this year, or 20% next year. That's a PEG ratio, so growth versus valuation of 0.4. Generally, anything below 1 is great, and below 0.5 is of course fantastic, right? So you've seen very strong growth, but you still have low valuations combined with high growth, and I think also, as Dilara and Egli pointed out, good macroeconomic fundamentals. All right, so please don't forget about our summit coming up in Tallinn. Again, it's the 20-year jubilee that we're doing this, so it's going to be early November, the 7th and 8th. And with that, I would like to thank you all and have a great summer.